Assalamu alaikum. Today we'll discuss the 7 popular options trading strategies in United States of America. Options are one of the most exciting areas of the investing because of their potential for huge gains. But to get started, you will want to know what option strategies are available, when they are best suited to particular situations, and what the risk and reward are. Option strategies come in very variety of flavors, but they are all based on the two fundamentals: options, calls, and puts. From these basics, investors can create a range of strategies that maximize the payout from a stock's movement, and savvy investor pick the strategy that's best for how they expect the stock to perform. Options trading strategies to consider. The number one, the long out. The long out is an option strategy where the trader buys a put expecting stock to the below to the strike price before expiration. Best of the use when the long put is a useful strategy when you expect the stock to decline and you want to earn a large upside. Traders will earn a significantly better return on their investment than by short selling the stock. So a long put could be a good substitute for shorting the stock directly. The long put also limits the short seller's loss to the premium, while shorting the stock exposes the trader to uncapped losses. Example of the long put: STK stock trades at $100 per share, and puts with a $100 strike price are available for $10 with an expiration in 6 months. One put costs $1,000, one contract, 1,000 shares multiplied by the $10 premium. Here they return at each stock price, including the cost to set up to the position. Risk over reward. The long put can pay off significantly if the stock moves below the stock price before the option expires. In this example, the maximum return is 10 times the original investment. For $10,000 in general, the maximum value of the long put equals to the total value of the stock underlying the trade, the number of contracts multiplied by the 100 the strike price. The risk for this potential upside is a complete loss of the premium paid for the put. But if the stock moves higher, making the put less valuable, traders often can salvage some of the value by selling the put, as long as it has substantial time to expiration. Number two, we have the long call. The long call. With the long call, the trader buys a call expecting the stock to be above the strike price before expiration. Best of the use when the long call is much like the long put, but it pays out when the stock rises. So if you are expecting the stock to move higher, the long call is the way to go. The long call can earn a much higher percentage return than owning the stock directly. But because the trader's downside is limited to the options premium, the long call also could be a good strategy if the stock has the potential to move much higher, but has the potential to move much lower too. If the stock falls, the options limited loss should be less than owning the stock directly. Example of the long call: STK stock trades at $100 per share and calls with a $100 strike price are available for $10 with an expiration in 6 months. One call costs $1,000, one contract multiplied by 1,100 share multiplied by the premium. Here's the profit at each stock price, including the cost to set up the position, from minus $1,000 to $600,000. So here we have the risk over the reward of this. The long call has uncapped the upside as the stock moves higher, and that's why this strategy can be a home run. If a stock rises, you can make money many times your investment. Like this long put, the risk here is that the investor could lose all the premium paid for the call. However, if the stock moves lower, making the call less valuable, traders often can save some of the value by selling the call, as long as it has substantial time remaining to expiration. Thank you so much for watching the video.